Ray Dalio advised, "Stop trying to time the market. Secrets exposed." Trying to time the market is a fool's errand, says billionaire investor Ray Dalio. In fact, you might be better off trying to beat Usain Bolt in a foot race or Michael Phelps in the pool, because it's harder than competing in the Olympics. Welcome to Investor Secrets. Today we're going to talk all about what Ray Dalio just said about timing the market. So watch the video till the end, because today's video is going to be the bomb. Now let's get to our topic. In an interview this week on the We Study Billionaires podcast, the Bridgewater Associates chairman said that most people are simply not equipped to predict which stocks will go up and which will go down and invest accordingly. Don't try to time the market yourself, because you'll probably lose, he said. The odds, Dalio said, are stacked against you. For instance, Bridgewater spends hundreds of millions of dollars a year trying to get an edge, and it's still competitive even for them. On top of that, Dalio said that individual investors often fall into the same traps over and over. The most common mistake of investors is to think that the markets that went up are good investments rather than more expensive, he said. Dalio referenced a high-performing fund that saw strong returns, but in which the average investor in it lost money because of attempts to time the market. Every time it was up, they bought it, and every time it was down, they sold it, he said. So their bad market timing was because they were reactive, thinking it's a great investment when it's up a lot. In 2021, Bank of America quantified the potential gains that a person who tried to time the market could miss out on. Dating back to 1930, missing the 10 best days each decade would bring a return of 28% versus the 17,715% return that would have been had if the person had stayed invested, CNBC reported. Investing legend Warren Buffett also said in 1994 that he never tries to time the market. Instead, he actively tries to never have an opinion about it. It wouldn't be any good, and it might interfere with the opinions we have that are good, Buffett said at the time. If we're right about a business, if we think a business is attractive, it would be very foolish for us to not take action on that, because we thought something about what the market was going to do. Instead of picking stocks and trading on a daily basis, consider buying low-cost index funds and holding on to them. This type of diversified fund typically stays relatively constant and avoids the ups and downs that come with picking single stocks. Passive investing in index funds has even been shown to be more successful than professionally managed funds, outperforming 92% of large-cap funds over the past 15 years, according to a 2020 S&P Dow Jones Indices study. Ray Dalio has also warned people against trying to time the market as uncertainty about the Omicron coronavirus variant shakes stocks. Dalio told CNBC on Tuesday that the most important thing for investors is to be in a safe, well-balanced portfolio and to not try to be too smart. You will not market time this, because even if you were a great market timer, the things that are happening can change the world, so it changes what should be priced into the markets, he told CNBC's Andrew Ross Sorkin. The discovery of a new coronavirus variant, which the World Health Organization has called Omicron, has triggered volatility in stocks after a placid period for the market. The U.S. benchmark S&P 500 index dropped 1.9% Tuesday after Moderna's CEO said existing vaccines were unlikely to be as effective against the new virus strain. Scientists are rushing to find out more about Omicron. In the meantime, investors have been left guessing about the possible economic impacts. Many analysts have recommended staying invested and said that the fundamentals of the U.S. stock market still look sound. Gene Bovin, head of the BlackRock Investment Institute, said in a note this week, "We stay invested for now, as a new virus strain and European COVID surge are hurting risk sentiment. Any delay of the powerful restart now means more later." Dalio, the founder and co-chief investment officer of Bridgewater Associates, the world's biggest hedge fund, was dismissive of those buying and selling around the volatility. To say, here's the stock market and I'm going to time the movement into the market, I'm going to time the movement out of the market, you're going to guess what the next variant move is, he said. The veteran investor did have some advice, however: stay away from cash. Dalio has long argued that cash is trash, given its value is eroded by inflation. He also weighed in on Federal Reserve policy, saying that simply printing more money to buy bonds isn't going to make the economy more productive. You can't raise living standards by raising the amount of money and credit in the system, because that's just more money chasing the same number of goods, he said. Dalio told Insider this week that diversification is key for investors in volatile times. You have to pay attention to inflation, and don't view being safe as being in cash, he said in an interview about his new book. Instead, you can have a liquid and diversified portfolio of assets. Now let's talk about Ray Dalio's 4 decision-making rules to remember. Whatever success I've had has been more due to my knowing how to deal with what I don't know than anything I know. Betting on the future is betting on probabilities, and nothing is certain, not even the probabilities. That's just the way it is. In a nutshell, here's what I try to do. Know all the possibilities, think about the worst-case scenarios, and then find ways to eliminate the intolerable ones. Identifying and eliminating the intolerable worst-case scenarios comes first. That's because the most important thing in playing the game of life or the markets is to not get knocked out of it. I learned that from a big mistake I made in 1982, which nearly broke me. After that painful loss, I calculated what my basic needs would cost and worked toward having enough money stashed away so my worst-case scenario would be tolerable. Diversify. In addition to making sure I've covered all the worst-case scenarios I can think of, I try to cover those I can't think of by diversifying well. I learn the math of it and I'm drawn to it instinctively. Essentially, if I have a bunch of bets that are attractive but unrelated, I can reduce my risks by up to 80% without reducing my upside at all. While this sounds like an investment strategy, it's actually an old and well-established good life strategy that I apply to investments as well. There's a Chinese saying that a smart rabbit has 3 burrows, meaning 3 places to go in case any one of them becomes dangerous. This principle has saved many people's lives when things got bad, and it's one of my most important principles. Put deferred gratification ahead of immediate gratification so you'll be better off in the future. Triangulate among the smartest people possible. I tag along with the smartest people I can find, so I can stress test my thinking and learn from them. It's through these principles that I got so much upside with relatively little downside, albeit with bumps along the way. That's why I recommend them to you, though as always you should feel free to take them or leave them as you like. That's all for today. If you guys enjoyed this video or think it was valuable, then don't forget to hit the thumbs up, subscribe to our channel, and hit the bell icon to get notified first. Also, feel free to let us know your thoughts about the next video in the comments section down below. See you soon. Bye.